Hello, fellow investors, and welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Chance Finucane. Chance is with Oxbow Advisors, which is an RIA firm based in Austin, Texas. And we're going to take a little bit of a divergence from the usual topics today. But as any good investor understands, you've got to have a strong understanding of not just real estate, but of the macro markets, what's happening, what's happening in equities and what's just happening in the broader financial world. And so we've got Chance, who has been an expert in this industry for going on 10 years or so. And he's going to give us an update today on kind of where we're at and where we need to be focusing, where we need to be staying away from. And I think he's got some great tips and tidbits about things to look into, even outside of real estate. So Chance, really excited to have you on the show today and looking for all the value you're going to bring.
Yeah, thanks a lot for having me on the show, Kent.
Well, fantastic. So before we really dig in, give folks a little bit more background on who you are and how you got to be where you are today.
Sure. So like you, Kent, I came up through the Kelley School of Business at Indiana University. Started my career working in the Midwest. And I actually investing runs through my family. My father's been in the business for nearly 60 years now and is still working as an investment consultant to hedge funds and high net worth individuals about the public markets. So stocks, bonds, gold. So always kind of had that background growing up with CNBC on the TV, growing up as a kid. And once I got out of college, found a job working with a global value investment firm in Chicago that really focused on working with institutional funds and whether that's pension plans or endowment funds, trying to invest what they had there. And that was a great place to really learn about all the different sectors of the market, develop your own style of investing. And then in the last 5 years, I've been working with Oxbow and their managing partner, Ted Oakley, and we work primarily with business owners after they sell their companies across three strategies. So we focus on investing both in a conservative strategy that's just in treasuries and municipal bonds. There's a high income strategy where you're trying to generate a good amount of yield that they can live off of, usually about a 5% blended yield that's supposed to beat the bond market. And then we also have an equity strategy that we're trying to grow at a double-digit rate over time.
Awesome. Well, it's a great overview. And clearly you and Oxbow and your background, you are the right person to have here today to tell us what's going on. So let's start at the top. I think everybody's reading headlines. There's a lot of FUD. There's a lot of fear, uncertainty, doubt. There's inflation, interest rates are high, right? There's all of this going on, but give us your take. What are you sharing with your investors as they try to make heads or tails of all these headlines and where we're at right now in the economy?
Yeah, well, I think where we would start right now is just trying to explain that after a 10 or 12-year run there, where it just seemed like the investment returns were really consistent and there was low volatility and it was really a great environment to generate solid returns regardless of what you were investing in. We now are back to a stage where you're going through a regular economic cycle, something like what we had from 2000 to 2003, or we had from 2007 to 2009. And these cycles take longer to play out on the downside than what we might have experienced. Just using the stock market as an example, we had a couple of 20 or 30% declines there in 2011, 2018, and 2020. But they never lasted longer than 1 to 3 months. And then stocks would take back off and go higher again. And we think that really kind of trained investors, especially if they haven't lived through those previous recessions, to think that, oh, we just got to sit through this for a little while and things will bounce back. But what we're noticing now is after all of that monetary and fiscal stimulus that came through in 2020 and 2021, there's this long unwind that's been in process for a little over a year now, and you're starting to see it affect asset prices across all different types of asset classes. And from what we try to track, we're looking at leading indicators that might point to where the asset markets are going and where the economy is going. And it suggests to us that things are going to remain volatile and continue to slow down for possibly at least another 4 quarters. So just to give a couple of examples, there are some leading economic indicators that usually do a good job of tracking what direction the economy is going in the next several months or several quarters. And these leading indicators have been going down for 12 straight months, and they've actually declined by 8% versus the same amount last year. And whenever you've had that happen, you're typically heading into a recession. One other factor we look at that your viewers may be interested in is they look at what's happening in terms of lending standards at banks. And we've seen a lot of tightening, especially at the smaller regional banks, where you've seen the headlines with Silicon Valley Bank, Signature Bank, and First Republic all going under. They're pulling back on their lending. And that usually means there's going to be less loan growth over the next 4 quarters, which also creates a drag in the economy. So just giving a few examples to start out that just suggests that it pays to kind of be mindful that this may take a little bit longer for this sort of slowdown to occur than what we're used to the past 12 or 14 years.
Gotcha. Well, I think that's good perspective, right? I think it's very easy to have a short memory when it comes to especially your finances or performance, right? I think it's I think, like you said, for people that don't have that perspective of multiple cycles, and maybe just haven't lived through it, haven't been through that experience, it can feel like the sky is falling right now, right, for people. And I think look at a lot of the major media, that's what they want you to feel like, because that's how they get views. But so it sounds like, I don't want to put words in your mouth, but we're more of kind of seeing a more historically normal cycle than what has occurred over the past maybe 10, 12 years, kind of coming out of the great financial crisis, right? Is that what you're saying?
Yes, that's what we're saying. So if you look at like in 2020 and 2021, you saw valuations, whether it was in the public markets or the private markets. Public markets could have been in stocks. Private markets could have been in real estate, or what you saw like in cryptocurrencies and venture capital. The valuations that things were selling for got to be such a high level because interest rates were so low and there was so much stimulus in the economy that really wasn't a normal market to be trying to value assets. And I think it's just good to have a reset and a reality check to remember that that's not a normal environment. We're now returning to what's going to be more of a normal environment. And just, for instance, some of the real estate, we had just seen a quarter reported by Realty Income, which is one of the major triple net public REITs in the market. And they're reporting that the acquisitions they're doing right now of single properties, they're getting a 7% cap rate on some of those acquisitions and are still able to generate a good return off of that. But we haven't heard about 7% cap rates being available for years. And that just kind of shows this sort of return to normalcy in valuations. And we're seeing some of that in the stock market. But if we look at where stocks are trading now, I think there's still a little bit too much optimism. Now, normally, if you were looking at a price to earnings ratio, which is a common way to value stocks, on average, they trade at 16, maybe 17 times price to earnings. Right now, it's more like 18 and a half, and it's even 17 times next year's earnings. So that just tells us you don't have to be in a rush to try and put your money into the market or get it all invested right away. We think there's going to be opportunities that develop, and it pays to kind of be patient and have that capital available for when there are really some great buys down the road.
That's really interesting because I feel like that's not, at least among the people I talk to, that's not kind of the sentiment right now. I feel like, because like you said, we've seen last year, 20% declines in the S&P, right? These big decreases. The talk track I often hear from folks, whether I'm talking to investors or other people in the industry, is, equities are down. There could be good buys out there because of these, I think, again, these shorter term look, right? But you're saying still historically, if you're looking at it, it sounds like equities are still quite highly priced based on where they've been, if you look back further in history, right?
Yeah, you're right. So it's not as crazy high priced as it was at the start of last year. So to put it in perspective, that price to earnings ratio, we're at 18 or 18 and a half times today. We were at 21 at the start of 2022. So it's not as outrageous as it was 16 months ago,
Mm-hmm.
but it still is above average. So what that means is if you're just buying in and not paying any attention to valuation, we wouldn't expect to get similar returns as you might have made in history. It'd probably be more like a mid-single digit return with a little bit higher than average volatility. And what we prefer to wait for is if there's some more economic slowdown and issues to come, that will create some volatility in the market and probably get that valuation down to where we think we can buy into some positions that we would expect those stocks to double over the course of 4 or 5 years. That's where we're really start to get aggressive. There's just not a lot out there right now. And the reason for that is there's a shift between sectors. So when you hit this point in the cycle, the things that were working really well last year were late cycle, cyclical sectors like energy or industrials. And if you look now, those are some of the weakest sectors in recent months that are starting to roll over. And that's what happens is at the start of a recession is you see energy, financials, industrials, materials, those tend to be some of the weaker areas, and people start to hide in the defensive sectors like healthcare, consumer staples, and utilities. And we've been seeing that shift for the last few months, and we think that just is going to take a little bit longer to play out, and eventually you're going to be able to have some buys in some of those sectors. But just to take example, we get some interest lately from clients about the really big drawdown in share prices for regional banks, for everything that's been in the news the last couple of months.
Mm-hmm.
And when we look at things on the surface, it looks like they're really cheap because they've gone down by 40% in value over the last 4 or 5 months. But there's still some data points we look at that, for instance, on days that they perform significantly worse than the overall stock market, they're underperforming by so much more than average. Historically, that's a bad sign that there still are systemic issues that tell us that there might be some more bad headlines to come, and it's just not worth jumping in as an investor. And where that relates to investors in general is just to be cautious around banks, though, that might still have a bit of a tough time with interest rates being higher and then pulling back on some of their lending.
Interesting. So explain that to me again. So you're saying that when you look at regional banks, again, the idea could be like, wow, they're down a lot. Are they on sale? But your take is because when they're down, they're performing worse. Explain that to me again, what that indicator is.
Yeah, I can explain that more clearly. So there's a term, there's a research group we use that helps us with evaluating the stock market that does great work. They're called empirical research. They have a term called downside risk. And what downside risk measures is on days where a stock or an industry underperforms the S&P 500. So let's say the S&P 500 was flat today and banks were down by 1%. That would be a day that they underperformed the overall index. On those underperforming days, are they underperforming by a lot, as in underperforming by more than they're outperforming on the good days? And when you see a lot of underperformance on the down days in a sector, that tells you that there's still a lot of controversy and concern in that area. And you need to see that start to dissipate before you really start to think that, all right, all of the issues that maybe are under the surface that you don't know about as a public investor, but you can see signs that there's still more weakness to come with commercial real estate and some of the small business lending. We just need to see more of that play out before we think that you would even start to look at opportunities to start investing in some of those regional banks.
Yeah, that's interesting. And is it the increased underperformance, is that because there's a disproportionate kind of flight out of those stocks at any bad news? Is that what causes that increased kind of downside performance, as you said? And it's because of just the kind of the uncomfortable nature of where they are, or Or is it this idea that like bigger institutions know more than we do, and they're fleeing the coop because there's potentially stuff that's going to come out, or I don't know, bad news ahead?
I think these days, it's impossible to know everything in the public markets and what's happening across all these companies and industries. So the information that's important for public investors comes out kind of in drips over time. And for example, today, we have PacWest Bank, which after the three banks that recently went bankrupt, PacWest Bank is the next one that people are concerned about. The ticker is PACW. And they've been, that share price has been going all over the place. But today, they're down 20% in their share price because there was a new data point that came out overnight that on May 4th and May 5th, they had 10% of their deposits get withdrawn by their customers. And that's something that just people aren't aware of, but people were starting to get concerned, like maybe this is the next bank that you might see a deposit flight that sends this company into receivership, and then the government will have to find one of the larger banks like JP Morgan Chase to bail it out. We don't know if it's going to get to that point, but having a random morning that you wake up and it's down 20% out of nowhere based off of a new news piece, that's not a normal sort of thing that happens.
No.
So it just tells you
that doesn't feel good.
There's more things to come. And if you look back in history, we've had previous credit cycles like this with the banks in 1990 and then 2008, I think everybody remembers. And there would be one big name, like in 2008, you had Bear Stearns that basically went bankrupt and had to get bought out at a very low price early in that whole 18-month down wave. And people wanted to say, oh, well, that was it. Now it's all okay. Well, there were dozens more banks that were going to have trouble over the course of the following year or two. And it just takes a while for this all to play out. So we just keep trying to preach patience. And if you think there's some awesome opportunity right now, it might be a little bit too good to be true. You need to see more fear and concern when you're talking to the everyday person to really know that it's time to get more aggressive.
Yeah, it's like that old adage of like, if your taxi driver is giving you stock tips, it's time to sell.
Yeah.
Exactly. So, okay. So this makes sense. So I'm thinking about this as what to look for. It's, the disproportionate downside really just because there's such a hesitancy about what's going to go on. So any bad news leads to like the sky is falling, big sell-off, which causes that big downside. And so it's just that volatility is that risk there. That's it's really interesting. I like that metric. I think I gravitate toward downside risk. So I think that's a great one to follow. So we talked about banks. Obviously those have been in the headlines, really timely. Another thing that's really been in the headlines is this idea is AI, right? Artificial intelligence, and you've got Chat GPT and how the idea it's revolutionizing industries. I mean, we already have applications in our business where we're using pieces of it. It's kind of just, it's wild the impact it can have. But is it buzz? Is there more there? How are you guys looking at some of these sexier companies now?
Yeah, outside of the two areas, we've been getting a lot of questions from clients lately. One is about banks and what's happening there, and is there an opportunity? We just touched on that. The other one is what's happening with AI. So the introduction of Chat GPT towards the end of last year is sort of the first AI model that you can interact with and ask it questions and get feedback. Microsoft's a big investor in that company. Google is announcing and trying to start rolling out their own version of this. And then there are other companies with a lot of exposure to this trend towards AI. NVIDIA, which is a major semiconductor chip company, is probably the one with the most exposure. What we noticed, though, and why people are curious is they're wondering, how do I get involved in this? What's our strategy? Are we going to miss out on the opportunity? And if you look back at history, we do think AI and what's happening here is going to be a very big deal and is going to have an influence across areas that we can't even foresee right now. Like, for instance, the last major trend we had was Apple introducing the iPhone in 2007. and it's still having ramifications on how we all live and interact and
Mm-hmm.
new businesses that are created in the 16 years since then. But in 2007, you could have never guessed that a company called Uber was going to pop up that would basically take out the entire taxi cab industry, or that a company like Instagram would be created and then bought out by Facebook, and it's now one of the most profitable businesses in the world. So there are going to be opportunities, but it can take 5 or 10 or 15 years for this to play out. And you just need to stay mindful and looking for opportunities and see what develops. You don't have to worry about missing out on the opportunity in the first 3 to 6 months. And what we're noticing is a group of professors just did a research paper on this. They're seeing that the companies with exposure to AI in the stock market are outperforming by almost 0.5% every day in the last, say, 4 or 5 months, which would be like the equivalent of outperforming by 100% per year, which is just not sustainable. So while we're being very mindful on this, we still want to make sure that we're disciplined in evaluating what these companies are worth based off the numbers that we think are reasonable to project. And we're just not going to chase as things run higher. If we look back through examples in history, there will be opportunities to invest in every one of these companies as the speculation kind of crests and then starts to fade, and the prices will come back down. One good example of this is, think back to the 90s when you had the internet come out. E-commerce is a huge deal. Amazon is the fast up and coming business. But you had a great opportunity almost 10 years later at the end of the dot-com bubble in 2002 or 2003 to invest in them at a discounted price. And you had another opportunity in 2009 at the end of that financial crisis to buy Amazon at a great price. So there will be opportunities for another 10 or 15 years as new businesses pop up thanks to AI. And we're just going to stay on top of it. But we really are trying to preach patience and not feeling like you got to decide right now what you're going to do with this.
I hear you. So yeah, don't chase it to the top. Be patient. Keep these companies in mind. It is a meaningful trend, as you even equate it to the iPhone, right? But as you said, with patient money, there will be opportunities to buy at the right price in the future. I think sound advice. Appreciate that, Chance, or bring me back down to reality as I playing with Chat GPT and figuring out new ways that we can just automate things over here.
Mm-hmm.
So as we just stepping back a little bit, I wanted to go back kind of broader economy, because I'm sure you guys keep a good pulse on this. I mean, one thing, as especially real estate investors, we keep a close eye on, it's inflation, it's interest rates, the interplay in between those. What are you guys seeing right now on the trends, kind of broader economy, as we look at some of these major drivers? What's your take right now with where we're at?
Yeah, so I think the difference with what's happening and where we're headed in the next year versus maybe what we all were used to from, say, 2010 to 2020 before the pandemic hit. Back then, at least in the United States, there was this very consistent model where you had only 2% inflation and you had 2, maybe 2.5% real GDP growth on top of the inflation. Well, if you add those together, you're probably 4 or 5% nominal GDP growth, adding up the real growth with the inflation rate. We're back to that 4 or 5% number in the United States again. The problem is 3.5 of the 4 is inflation. So we actually think that the inflation rate, while it's been coming down and probably will come down to between 3 and 4%, based off numbers that we see, we think it'll stay elevated at that 3 or 4% level, at least through the first quarter of next year. And we think that's actually why the Federal Reserve is staying so focused on fighting inflation, and they want to keep that Fed rate high at about 5%, because they know the long-term effects of letting inflation get out of control. Because if you look back at history, like in 2018 or the early part of the 2010s, they would usually be quick to try and come in and help out the financial markets if you saw a bank announce that they were going under, like we had in the last couple of months. But they know that the inflation thing is a bigger factor. So we would actually expect that, you see a slowdown in growth, maybe only like 1% real GDP growth, and then still that, say, 3.5% inflation rate. And what that does mean, that hopefully will be a positive for real estate investors, is we do think that the long-term treasury bond yields, so 10-year treasury or the 30-year treasury, we think the highs have been made in those treasury yields for this part of the cycle. So they got to about 4.25%. Those have been trending down, and we actually think that would continue. They could even fall back below under 3%. And at least maybe that gives you some better entry points, to see some appreciation in some of the real estate properties that you do own.
Yeah, and better cash flow, right? As we, I think, unfortunately, I think the days of those super low rates are gone. Those, as we've had the theme in this show to look back at more historical averages, we're definitely outside of the norm. I think that's really important for people to understand. But there's a certain I think a certain understanding or perspective that I have that, if you real estate or other things you can relate to as well, like, if your deal only works with your interest rate at 3%, it's probably not a great deal. Probably a little tight. You're probably buying at a high, like we talked about, stocks and other things. And so it's okay to, to have normal interest rates, and deals can still be made. People were doing deals in the 90s when interest rates were higher, and even before that. So I think it's just a matter of, like you said at the beginning, of people widening their perspective back more to historical averages and kind of getting used to that. We've all been spoiled over the past 10, 12 years, right? So I think great perspective. Appreciate that. Well, how do you handicap where we end up? Are we landing soft? Are we landing hard? Are we somewhere in between? How do you guys, what's your perspective there on likelihood?
Yeah, I think more likely than not, we're starting a recession sometime in the next 9 to 12 months. You can't be too exact with those sorts of predictions, but we would expect more of a hard landing. We just think there's still some excess in asset valuations and in the economy from the last few years that needs to be taken out of the system. And it's in process, but there's still a bit further to go. And we actually expect it to hit a little bit more in the private market. So you're already seeing a little bit of headlines where some private equity and some venture capital firms have had to mark to market some of the things they previously bought at really high prices, and then they have to mark them down by 20% or 40%. We think there's some more of that to come, and it'll set up a great opportunity, hopefully sometime in the next year, but we do think that it's going to be a bit more choppy for longer. And right now, we're really just focused on trying to find reasonable things to own that can deliver a good yield for our clients in the meantime, so that we can generate a positive return while we wait for that great opportunity on the horizon.
Yeah, no, appreciate that. I think that's a good answer. It's largely the perspective I share, and appreciate your insight there. I know with your experience and resources, maybe your crystal ball is a little less foggy than what we have here. So it's just great to hear different perspectives, but understanding that it's really hard to predict the future. But so appreciate you putting that out there. With the time we have left, I know we've talked a lot about what to stay away from. I know you've got perspectives in a number of different areas on things that you guys like right now. So give us a few tips there. Where are you guiding your investors at the moment based on everything we talked about?
Yeah, we walked through everything to stay away from, which is a good place to start, eliminating, the excess. But where we are placed and where we have our clients invested, just as a starting point, short-term treasuries are yielding 5% for the first time in over a decade. And that makes it a really good place as a starting point and as an opportunity cost. If you're going to compare some other investment opportunity, is it worth taking the excess risk? It's got to be a pretty high expected return to beat a free 5% for as long as the Fed keeps short-term interest rates at this level. So we've still got a good amount of our clients' money invested there, just almost as a safe place to be. We also still think long-term treasury yields will continue to come down, which means those bond prices will go up. And that's been in the works now for several months. And then what we've actually been seeing is with the rise in interest rates in general, it means that some of the valuations on different types of stocks have actually started to yield 6% or more, which is a long time since that's happened, and something that can easily cover those dividend payments and maybe even provide a little bit of growth. So three areas where we're seeing that. One is related to your group. There are some public REITs that we consider good quality that have at least a 6% dividend yield. Two in the healthcare space are Physicians Realty, which owns medical office buildings, and Omega Healthcare. Another one is National Storage Affiliates, which is one of the major self-storage REITs in the stock market. Those are all yielding 6% or higher. One other area, even though we're being cautious on the more exploration side of the oil sector, there are oil pipeline businesses that their cash flow is derived by the volume of oil and natural gas running through their pipes, not based off the price in the economy. So those are actually good places to be. They have great balance sheets and they pay a 7 or 8% dividend yield. And those are companies like Enterprise Products, Kinder Morgan, Magellan. So those are some areas that we go. And then the last one that's popped up is wireless telecom. We actually think is settling into this kind of normal oligopoly between Verizon, AT&T, and T-Mobile, where they're all going to have pretty similar market share of the United States for wireless customers. And we think they'll be able to generate consistent free cash flow. Verizon and AT&T, their valuations have come down now to where they pay a 6.5 or 7% dividend yield and are trading at a valuation that's below their historic average. So while we're not expecting the stock to double or anything like that, when we don't see a lot of upside in other areas of the market right now, these are good places to be, just to be able to get that solid 5, 6, 7% yield, and then maybe get a little bit of price appreciation while you wait for a little bit more volatility in other areas of the market.
Yeah, it seems like kind of general theme there of just, protecting cash, staying in, relatively safe areas. You can't go wrong with a money market that returns a 5% interest rate. That's very unique, I think, right now. Sounds like bonds, sounds like a few stocks really focusing on quality dividends. One other one I was going to ask you about is, so we talked about these regional banks and the issues there, but it seems like the winner in this are the money system banks, the larger banks that are acquiring these at a discount. I mean, is there a play there in some of these? You think about the Chases, the Bank of Americas, right? Citigroup, these guys.
Yeah, you're right. They are the relative winners. So there's 4 systemically important banks, the too big to fail banks. So it's Citigroup, Bank of America, JP Morgan Chase, and Wells Fargo. Those 4 are actually getting more of the deposits that are leaving the other smaller banks. So we own their preferred stocks, not the common stocks like you'd see in the stock market, but their preferred stocks that are just kind of like one level above in the value chain, and they'll pay a 6 or 6.5% dividend yield. You don't get the same upside in the share price, but it does provide a pretty consistent yield that we think they'll be able to pay through a recession or through a full cycle. We wouldn't be investing in the common stocks of even those 4 big banks, because an underlying concern is, even though they're going to be able to survive, a big part of the earnings per share that are realized by banks comes from the spread in interest between what they can generate at offering a loan at this rate and then what smaller rate they're paying to their customers on deposits. And
Mhm.
right now, they're going to have to pay a higher and higher rate on those customer deposits, which shrinks their net interest margin and is going to shrink their overall earnings they can report. So even though they're going to survive, we don't know that they're really a great place to invest until you really start seeing the Fed cut rates in a significant way.
Gotcha. Makes a ton of sense. And I appreciate you explaining that spread, because you're right. With short-term rates so high, we've seen it. I mean, I've seen it in our own accounts. Those interest rates going up quite a bit on deposits. So good for the consumers, not so good for the banks at the moment. They've had their day of like 0.01% interest rates for long enough now. But I love the preferred stock idea. So appreciate that tip. So again, focusing on kind of current yield, right? In all of these tips. Well, Chance, it's just fantastic expertise and advice. And I think it all resonates with, similarly my understanding. And I think everybody recognizes that while we prefer real estate with what we do, nobody should have all their eggs in one basket. And so there's always a place for a diversified portfolio. So as we try to make our listeners better investors, I appreciate you filling in some of those other pieces of things that they can be looking at to protect cash flow right now. It sounds like really a time to, maybe pick off some easy dividends and gains, but keep some powder on the sidelines over the next 12 to 18, 24 months as you think some deals may come about. And I guess the important thing is to get an expert like yourself so we know when those deals are coming through. Appreciate you coming on today and sharing all that. Before I let you go, I want to take you through our keys to success round that we ask everybody. And the first question there is, if you were going to place your money, or maybe in your case, your investors' money into a deal, and you could only ask the sponsor one question, what would that one question be?
I'd want to know, what is your edge? What is the thing? There's a lot of very smart, motivated people operating in the financial industry, trying to do deals. What is it that you have that differentiates you from everybody else out there trying to do the same thing?
I like that. I mean, it goes back to, it starts with the sponsor, as we talk a lot about, that's the number one thing I think important in the deal. And, it gets down to, what makes that group? I'm sure you guys have a lot of people bringing you deals. So what makes that group or person special, right?
Mm-hmm.
And what gives you that edge, that alpha ultimately?
Yeah.
What are you most proud of in your career?
I think just being able to join Oxbow and really help Ted Oakley and the rest of this team build out our equity strategy and continue to assist with the other income strategies, and really just build up this firm together with really an outstanding group. And I think we're all just super optimistic about continuing to grow this firm for many years to come.
Very good. What is a book that everybody should read?
I can give you one investing one and one not related to investing. So in terms of just a general book that I've probably gifted to the most people, I always come back to The Obstacle is the Way by Ryan Holiday. A very digestible read on stoicism and just sort of a good framework for your life. And then in terms of investing, I think a good one to look at right now is Howard Marks, who's a legendary investor. He wrote a book called The Most Important Thing Illuminated, which is the best investing book I've ever read on risk, which is a good time to read that right now.
I love that. And lastly, what is your number one key to success?
At this point, I would say consistency. It's something that I think you really learn and develop when you begin and go through your career, of just being able to stay focused and knock out what you need to day after day after day, and just build up that increment of knowledge and expertise and execution. And it really compounds in a huge way over time, but it's not something that everybody can do when you're talking 250 work days a year and talking about a decades long career. You need to be able to adapt and just continue to deliver.
Yeah, absolutely. I mean, consistency is key, and just showing up is half the battle, right? And being there every day. Well, thanks, Chance. Appreciate you coming on the show and providing so much value. If folks want to reach out to you and learn more about Oxbow, how can they get in touch?
Yeah, you can go to our website at oxbowadvisors.com to learn more about us. And our marketing team has also built out a fantastic YouTube channel. You can search for us on YouTube at Oxbow Advisors.
Awesome. We'll make sure all that's listed below so everybody can reach out and get that content. And with that, Chance, we hope you have a great rest of the day.
Yeah, thanks a lot, Kent.